Welcome back to the Dynamic Growth Podcast. My name is Nate Crosby. Today on the show, we are going to look at how the wisdom of Sherlock Holmes can help you decipher the macro environment.
We're also going to be talking about the most recent data coming out of the labor market. The U.S. non-farm payrolls for the month of July came in above expectations, 187,000 jobs compared to 170,000 jobs expected. Why that number might not be what all that it's cracked up to be, and reasons why you shouldn't get too excited about that number. We hope you enjoy this week's episode.
I'm going to try a little bit of a thought experiment, Derek.
Like Albert Einstein.
Like Albert Einstein, what I'm going to try to do is connect the genius of Sherlock Holmes and who's the author from the book Think Fast, Slow?
Daniel Kahneman and Amos Tversky.
Oh, there's actually two people that wrote it?
Yeah, the one guy did all the research with Danny Kahneman, but Amos Tversky died when that book was published.
Oh, no kidding.
Yeah.
So I was reading Sherlock Holmes, and I came across this line, and it said, this was Sherlock Holmes talking. He said, "It is a capital mistake to theorize before you have data. Insensibly, one begins to twist the facts to suit the theories instead of the theories suiting the facts." And then going on that same night, I'm reading a book. I'm continuing to read that book, Think Fast, Slow. If anybody has not read that, and they're interested in how the mind takes in information and the stories we create to tell ourselves, that's a fascinating book. There was a thought experiment in there, and I'm going to change I can't remember the exact name they used, but they gave limited information. And the question was, they told you that Sam is intelligent and strong. And so they ask you, based on that information, is Sam a good leader?
Are you
asking you?
Oh, you're asking me?
Yes.
Well,
Sam is intelligent and strong.
Yeah, well, like I kind of have some inside knowledge because I'm like working my way through the book. Your instinct would be to say yes, but you would just based off those two data points, you wouldn't have enough information to determine because there's like a plethora of other characteristics you would like to see in a good leader, not just necessarily those.
Yeah, but
things.
Based on the story or the facts that you know, Sam is strong, Sam is intelligent. The only story that you could possibly tell or say is that yes, right? Based on that information, he's a good leader. And then suppose a quarter goes by, and after that quarter, they release two more adjectives to you. And now we know that Sam is strong, Sam is intelligent, Sam is also corrupt and cruel.
And stubborn.
So you ask yourself again.
Yeah, right.
Yep. Is Sam a good leader? And of course, the answer would be no. And we talked about this in previous podcasts that all the information is not known, right? We can look at the macro environment, and what we don't know sometimes could creep up and bite us, right? And sometimes the information that we have is not complete. So we put together a story of how things are, but because we don't have all the information, that story is not complete either. And so I was just curious I wrote down some information or some ideas, but looking at the past quarter, what are the new adjectives that have come into the market that maybe weren't there in previous quarters, in your opinion?
I like that's a good way to frame that. I like your setup there. That's good. So like new data points. Well, one of the biggest lessons I've learned over these past 2 years is that price leads narrative. You'll have like NVIDIA. I know I'm just like a broken record with NVIDIA stock, but it's just such an interesting case study that it can be applied to a lot of different things. But so last year, NVIDIA sold off 67% or 68%. And it was, the whole narrative was, semiconductors are super cyclical. If we have an economic drawdown, like semiconductors are going to be one of the most battered down sectors of the economy. Like even if they're profitable, even if yada, 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 there's nothing that they can do because they're so cyclical. And then just because of like basically a narrative switch, and also to caveat this, there was new data to suggest that NVIDIA stock was going to be strong. Like they announced that they were going to do a lot better than what was expected. So I mean, maybe Nvidia isn't the greatest example, but just like as far as the economy as a whole, maybe we'll use that as an example. So like the economy was down last year, and basically you couldn't find a person in the world that was like bullish on the economy. Like they do like those consumer sentiment things. Everyone feels poor, so they're like the outlook on the economy is bad. But that's just because of their portfolio in that moment. And then now, if you fast forward just 6 months from, or 9 months now from the end of last year, since stocks are up, people feel wealthy. They're like, oh, no recession, we get no landing, soft landing, all these. Like people feel pretty confident in that call, even though all of the arguments of why the economy was going to be bad in 2022, I mean, outside of some different data points and stuff, we didn't get like confirming evidence that we were out of the woods yet, especially because like monetary policy has like these long and variable lags. So it's just that this was like the most long-winded way to answer your question. I apologize. I went off on a huge tangent there.
No, it's perfect.
Okay, cool.
It's perfect because if you look back to Sam, nothing changed with Sam, right? Sam was always strong, intelligent, cruel, stubborn, but we didn't know that about them, right? So as things come about, I mean, that's why investing is never going to be an exact science, because there's always new information that's coming out that you maybe didn't know. Maybe things aren't as extreme as what they potentially could be. You apologize for talking about NVIDIA, but I don't see how you can't talk about NVIDIA. The one thing that the past quarter has showed us about NVIDIA as a company is they are a monster. I mean, we were interested to see the results of last quarter, the quarter that they just put out, a week ago or so. And they had some hurdles to climb, to kind of, with the growth that they had already that year, they had to put out a monster quarter, in my opinion, to keep from having a pretty strong correction. And they did that. Mm-hmm. I mean, that quarter was amazing.
Yeah.
I think if you look at, so your comment that price drives the narrative, is that what you said?
Yeah, price leads the narrative. So like
leads the narrative.
Yeah, right. So price, like people will basically, to your point, like, or I guess the point of thinking fast and slow is people will like complete the picture just because of like stocks are going up, and then they complete the rest of the picture of the economy's strong, we're not going to have a recession, just because of the price of the stock market, essentially.
So you pointed out to me earlier this week that there was a bit of a disconnect between the revenue year over year that a lot of the companies in the S&P 500 have, yet something like 60% of them have beat their earnings expectations.
Yeah.
And so that again, I mean, and this might lead, I know at some point we're way off topic here, but at some point you want to talk about the non-farm payroll.
Yeah.
I mean, that would be a perfect example of, right? It beats what is expected. Maybe not as rosy if you just looked at the pure numbers of what the companies are reporting year over year, but the fact that it beats expectations drives the confidence in the investor.
Yeah, so I'll include, it's such a crazy chart, so I'll definitely include it in the video in post-production, but this was a chart put out by FactSet. They do these great reports that are accessible. I think they're free. Like they post them on Twitter, and you can read these like 20-page reports they'll put out about just the earnings and revenue of a specific quarter, and you can get so much value out of them. They post all these really interesting charts. But the one chart that I'd sent you was basically a sector breakdown. So like the earnings growth year over year based on each sector. And you can see that like, so I think we talked about this last week where we said that like there could be a recession in different areas and not other areas. Like if we do have a recession in the future or in the near future, there could be some sectors of the economy that are completely unfazed by it. And this kind of is painting that picture, giving evidence to that. So you see like consumer staples, communications, real estate, energy, and materials all down double digits in earnings growth year over year. Those sectors are flat, give or take for the year. Some of them are up, some of them are down. And then you see like information technology up 40% from last year. And then to your point about the expectations. So the aggregate earnings growth of the entire S&P 500 was negative 19% from the same time last year. So it's a pretty big drawdown. But 60% of the companies in the S&P 500 beat expectations. And if we know like how stocks move post earnings, we're generalizing. If if you beat expectations, you're probably going to get a rally, or if you like raise guidance,
Sure.
you're going to get a rally. Even if the numbers are down year over year, like you could still see that pop in growth. I think it was Salesforce that also just reported. They reported like way better than everyone was expecting, like way better. But the numbers are still down year over year, and I believe the stock is up from where it was last year. So it's like the new information of like better than what everyone was expecting is more important than the actual raw data.
Yeah. And we see that quite often. We see that with companies. Upstart would be one
Strong revenue.
We joke around about. Yeah, right. We joke around a lot about that stock. But I don't know if it was last quarter or the previous quarter. They lost revenue, but it wasn't as bad as expected. Mm-hmm. And because of that, the stock rallied, right?
Yeah, right.
It's not as terrible as it could have been.
Yeah.
So we're gonna go ahead and rally.
And then what's Upstart up for the year? So like Upstart is already up 158% for the year. And they're having negative year over year revenue. So
sure. Go chase that one.
Yeah, have fun.
Here's another piece of information that has come out that I'm interested to see. We talked about the housing market, right? We talked about real estate, interest rates going up. In the beginning of the year, the speculation was that real estate was really going to suffer. And if you were invested in Vanguard's real estate sector, then yeah, you suffered because that's going to own commercial real estate and a lot of other things. We talked about the new home builders actually have done very well. What's amazing to me, in hindsight, I guess you could see this. But if you look at everybody expected the housing market to kind of come back, right? And we really haven't come back as far as these crazy valuations on these homes would drop. We'd see the drop by 20 or 30%. And so far, it hasn't happened. They've actually continued to rise. A lot of that has to do with the fact that the supply, the inventory, right? If I'm sitting on a mortgage, like if I look at my mortgage for my house, I'm at 3.25. I'm never going to sell that. I'm never going to refinance. It might be distant future before I'm in a situation where that makes sense for me to move, right? And so because of that, you're seeing people who maybe would move, but they just can't, mathematically, they just can't make it work.
They would have to take like cost of living, like they would have to adjust their. So okay, let's do some quick math here. So if you bought a property at $250,000, or let's say like $400,000 at 3%, and now interest rates or mortgage rates are like 8%, I think it's
7, 8, yeah,
something like that. So you, on a $400,000 house that you bought at 3%, you can now afford like close to $300,000. So you're taking like a 25% haircut, and the prices of the properties have moved up. So if we're talking about adjusted for appreciation, it's a worse house, generalizing, because it's cheaper, but it's also worse relative to the price at which you bought your house. So it's like a double whammy where you're going to pay more for less house.
Absolutely. I want your thoughts on this. So it came out last week, a couple weeks ago. Credit card debt, people paying off their credit card is at an all-time low. We have all-time high credit card debt. But if we look at in that by itself, you might take that piece of information and speculate that, well, all this spending has been pulled ahead, and now we've got a situation where consumers are maxed out on credit. We've got student loans that are coming due in September here that will begin. But one piece of information that I think that doesn't tell the whole story is, while credit card debt is at an all-time high, the credit card default is not. So it's nowhere near an all-time high, which would have been the housing market crash of 07, 08, that period of time, 7, 8, 9. And so I don't know if that is, and I guess I want your opinion, I don't know if that is a product of credit card debt's at an all-time high because income's at an all-time high and inflation is at an all-time high. So maybe that debt is just inflated by the fact that things cost more. Or are we in a situation where people are truly at the ends of their ropes as far as credit that's available to them, and we're going to see a drastic decline in spending going forward?
Yeah, I don't have the numbers in front of me, but you would definitely have to do two things with that number. You'd have to adjust it for inflation, just because things are more expensive. Like the nominal amount of credit card debt is going to be higher. And then like demographics, there's going to be more people. So you have to adjust that to compare apples to apples. But also you have to compare it to like what you said to income. So it'd be like the amount of credit card payments as a percentage of total income, like a debt service ratio, is what you would want. So like if people are like maxed out on the amount of house that they can buy, let's say they're spending like 30 to 40% of their gross income on a house, and then you get however much you're servicing towards credit card debt. The things that could that's kind of what the number that you should be concerned about is the people's ability to service that debt, not necessarily the total amount of debt that they have.
Yeah, absolutely.
And then the curveball would be like if interest rates increase, and so you're paying a minimum payment on your credit cards, and then interest rates go up, you're going to have like higher payments. So that kind of starts to eat into your buffer. Like if you did have discretionary income, which I think a majority of Americans do not. I think a majority of Americans are living paycheck to paycheck. They don't have discretionary income. Well, they don't have savings, I should say. That's going to definitely like crunch margins. You're going to decrease spending in other places for sure.
Yeah. The last thing I'll point out, and this will be yet to be seen in the coming quarters if this is actually true. I was listening to Best Buy do their quarterly report, and one of the things that the CEO said was that they believed that as a company, they were at the bottom of. So Best Buy benefited from COVID. While people were, sheltered in home, people went out and bought televisions. People went out and bought computers, and they upgraded all their technology so they could enjoy their life there while they were stuck into their home. And then as we kind of went back out into the world, that Home Depot saw the same thing. Those kind of purchases began to slow down. But the difference in technology is you go through this like upgrade cycle, right? Where the technology that you buy lasts a couple years, and then something new and better is out there, right? And they feel they are kind of at the beginning of that upgrade cycle where people are going to be going back out, buying computers, buying televisions, buying things to upgrade there. So you might find, the reason why that caught my attention is we look at retailers, Derek, and they have gotten hammered in the past couple months. I mean, Nike was, you sent me two of them actually. We looked at Nike and we looked at, what was the other one you sent me?
Foot Locker. Foot Locker had a really good quarter, yeah.
Yeah. Which I commented, I can't believe Foot Locker's still in business with kind of where they had with their business model was essentially in every mall.
Yeah, right. Yeah, seriously.
But that'll be interesting to see for me. Some of these retailers, even though they've gotten beaten down, potentially, according to what they reported, they might be at the beginning of another uptick as far as purchases.
Yeah, I just think that still maintain the view that, okay, so like let's just look at student loan payments, for example. That's just like one more thing that is going to be incrementally hurting the consumer. I just think like to your point about the credit card debt and then student loans and then like increasing mortgage costs, like not everybody's, and actually the data supports the view that people aren't moving really. Like, so that was like the whole thesis behind the home builders. People aren't selling, but people still need houses, so they're buying new constructions. But it's not like mortgage debt is taking up a big chunk of anybody's income. But I just think that so I guess this might lead into what I wanted to talk about with the stuff starting to crack in the labor market. All of these growth expectations of, oh, we're going to do this much in revenue, but your product is purely discretionary. All of those numbers change if the median household income is $60,000-$65,000. That's household income. What if one of the people in that household lose their job? All of these numbers on discretionary spending get thrown out the window. All these numbers on I'm not going to move out of my 3.5% mortgage. Well, it's like you might have to if you can't afford the house. So like I think it's just been so long since we've had an economic downturn that people like don't realize like what actually happens in like the second and third order effects of like somebody losing their job, like half of a household losing their job. I mean that's going to definitely impact discretionary spending. Yeah.
So the unemployment rate right now is what, 3.8%?
Yeah, so we got the number today. It was 3.6% expected and then 3.8% reported.
Yeah, still historically very, very low.
Yeah. And then, It was actually, so like the labor force participation rate is like we always give grievance to the unemployment rate because it doesn't count like people that aren't looking for a job. But the labor force participation rate was actually up. And unemployment was up. So, I mean, you could kind of see that as a wash, I guess. Like, not exact. It's not 1-to-1. But you can see, like, more people are looking for jobs So of that number, like if some of those people can't find a job, that would impact that unemployment rate.
So let's go ahead and lead into your segment, because I think this is a perfect time to do that. We opened up the podcast talking about Sherlock Holmes, and I think you may have uncovered a mystery here with the labor market.
Yeah, I mean, I don't know another way to put it besides like just outright fraud. I just think that it's I don't think that it's possible that the expectations for the non-farm payrolls are this wrong relative to like how they get revised the next month. So I can just get into the numbers here. So these are year-to-date numbers. So this is looking at January, February, March, April, May to August. So I'm going to bore you with some numbers here, so feel free to fast forward. But the January report for non-farm payroll was 517,000 jobs, and that was revised lower to 472,000 jobs. And that story basically plays out where it gets revised lower every single month this year. So this most recent month was July, so we just got the numbers for the July reported in August. It was 187,000 jobs added in July, and that was revised lower to 157,000 jobs. So that was a 16% revision. So, I mean, we're seeing some really big revisions. Basically, every month this year, it's been revised lower. In some of the cases, it would have been revised lower to where it wouldn't have beat expectations. So we're in this scenario where the front page of the news is the economy or non-farm payrolls added X amount of jobs, and then on page 60 next week or the month later, it's like actually that number was wrong. We didn't do as hot as we thought we were going to. It was revised lower to this. So you're basically like setting a bar, and then like artificially saying that you got above that bar, but it's like. And that's the number that everybody celebrates. But then a month later, when everyone's moved on to the next thing, it was actually, you never cleared that bar in the first place. And that's happened basically every month this year.
Yeah, because that's behind us. And the equivalent of that would be a publicly traded company coming out and saying, here's what we did. And the market applauds it because it's better than expected. And then you said a month later, they come out and they said, actually, we didn't do that good. We're about 16% light on our revenue. But it's printed on the back page somewhere, so nobody actually sees it.
Yeah, it would be like like if a company like issued lower guidance and everyone was like, man, sell the stock. And then they come out next quarter and they're like, we beat this number that we like totally handicapped ourselves with. And like if you did that systemically, like if you did it knowing what you were doing, like you would like charges would be pressed. That's fraudulent. Like so like these economists that are predicting these non-farm payrolls and the people that are like reporting the number are either just really bad at their jobs and they're not even getting close to what the expected number should be, or what the estimates are. They're getting these numbers way wrong, like systemically wrong.
Okay. So if you are not here next week for the podcast, should we assume that somebody from the non-farm payroll has come after you?
Yeah, probably. Whoever, I think is it ADP that ADP is another number, but
they take an ADP number. Yeah.
Yeah, for sure.
Well, what else, Derek? Anything else we want to talk about today?
I would just like to call out this. I'm going to do a little bit deeper dive because a number that's baked into the non-farm payroll number is government jobs added. So last week we touched on a little bit of the Bidenomics, like why the recession keeps getting postponed. So part of that was because of this term, or what has been termed Bidenomics, which is basically the government providing a blank check to basically every single thing that comes up that they want to fund. Like there's basically no restrictions on spending, even as the interest expense approaches $600 billion and will get refinanced into over $1 trillion. Like this is like these budget deficits that we're running are completely unprecedented in non-war times. So like during war, like that we've seen higher budget deficits, but this is the highest non-war budget deficit that we've ever seen. And like that works as far as like kicking the can down the road as far as a recession. So, I mean, if the government is just like employing all these people just to get these numbers to be better than what to be better than what they actually are, like in the free market economy or the private sector, I mean, that would have an impact. So I wanted to do the numbers on how many of these non-farm payroll jobs are just added by the government.
And you can find that. I think we're going to put that in next week's newsletter. So if you don't get our newsletter, you can go to our website, sign up for it. I think in September or October, Derek, we're going to have another showdown with the budget with our federal government as we had earlier this summer.
Yeah, right. I mean, since the government since the debt ceiling debate, which I believe that's the end of June, is that right?
I believe so.
So since then, we've added $1.4 trillion to the debt. And then part of that is that's looking forward. So it's not like we spent that much money. They'll raise that the Treasury will raise that much money to spend. So it's not like all of that money has been spent, but that's just been raised to spend. So yeah. Mm-hmm. So I mean, they basically blew their new allowance in the first week, and now we're going to have another debt ceiling debate later this year.
Buckle up.
Yeah, it's going to be interesting. And then next year we get the election stuff, so it'll be really interesting. And then especially if we do get an economic slowdown, there's just so many things that are going to happen next year. It's going to be buckle up for sure. That's my call. I mean, take it for what it's worth.
Well, Derek, where can people find us on social media?
As always, thanks everybody for listening to the podcast. If you liked it, share, subscribe, wherever you get your podcasts. Follow us on Instagram, Facebook, LinkedIn, YouTube at Crosby Advisory. Subscribe to the newsletter by going to crosbyadvisory.com/contact, and we'll see you guys next week.
Keep in mind that Crosby Advisory is a registered investment advisor in the state of Ohio, Texas, and Florida. At any time, you can request our Forms ADV 2A and 2B, which go into the business practices and qualifications of Crosby Advisory. Today on the show, Derek and I mentioned specific securities, and that is not a recommendation for you to buy them or sell them. Do your own homework. Make sure they are suitable for you. Keep in mind, investing is a process that involves risk, including the potential loss of principal.